Hello, class. I just wanted to touch base with you and maybe give you some pointers on doing the aggregate supply, aggregate demand analysis using some example problems. Now, you've had some chances to do this in your practice module, your practice for module 10 exercise, and in some of your homework problems. But maybe this will help you. I'm going to walk through maybe a methodology here that might help you sort out what's going on. So I'm going to share my iPad screen with you. And so I'll be looking down only because I'm drawing, but I'm here and you should be able to hear me and hopefully I can walk through this clearly for you. So in this problem that you're looking at, this is problem one, you're given some data in a chart format. From this data, you're going to be answering a couple of questions. These are basically the questions that you would answer with all of the analysis problems that were going to be presented to you on the exam. So let's take a look at the structure around which we analyze this and see if that helps you. So first of all, let's look at the chart. That has the information that we're going to need to actually make our decisions here. So at the top of the chart, I'm trying to figure out how to get this. There we go. That's what I want. Okay. Okay. At the top of the chart, you have three pieces of information, generally the same three pieces of information that you'll get. Number one is GDP growth. Number two is unemployment rate. And number three is CPI, the Consumer Price Index. So let's look at them line by line, see how we use them. And at the bottom, I have our aggregate supply, aggregate demand model drawn at equilibrium, where long run aggregate supply equals aggregate demand. This is our long run equilibrium. This is where the economy wants to be, and this is where we're going to start from. So the first thing I notice when I look at this chart is I notice that when it comes to GDP growth, okay, we've got 1/4 of negative growth, 2/4 of negative growth. Okay, so I'm seeing a downward trend, put a 1 there, and GDP growth, which means likely, clear that up a little bit. Okay, that's down and that's 1. So what that means to me is that we must be moving from left to right along the x-axis, because the x-axis is the economy's real GDP number, and if it's getting smaller or decreasing or shrinking, then we must be going in that direction. Okay, now look at unemployment. So unemployment is going from, and there's three unemployment numbers because in a fiscal quarter there are 3 months. Unemployment is measured monthly, so is CPI, or the Consumer Price Index. However, GDP growth and GDP numbers are measured once a quarter, not once a month. Okay. So unemployment starts at 5% and then it ends at 6.9%. Okay, so it's generally going up. Make that 2. Now it's generally going up, and we're going to assume that the natural too high, it's not gonna. We're going to assume at all times that the natural unemployment rate, oh, I'm having a rough day here, guys. The natural unemployment rate, there we go, is equal to about 4.5%. Okay. Now, two things are going on here with the unemployment. First of all, we know that the unemployment rate is getting higher. All right. And notice that at the end of that spike, actually throughout the whole time, it's above the natural unemployment rate. So if the unemployment rate is above the natural unemployment rate, I'm going to write this down. Unemployment rate is greater than the natural unemployment rate, which means that we must be that employment is below full employment. Okay, remember that the natural unemployment rate is the rate of unemployment that we expect to exist in the economy. And if we're higher than that, it means that there's more people out of work than we expect to be out of work. We have some cyclical unemployment. And if this is the case, then if we are less than full employment, the economy must not be working to its fullest abilities, because we're not using all of our labor resources. So real GDP must be lower than potential GDP, which means that we have to be somewhere on the left side of long run aggregate supply. Somewhere here, our equilibrium must have moved to somewhere in this area, because that's where unemployment rate is high, and we're below full employment, and we are not producing to capacity. If unemployment were lower than the natural unemployment rate, of course, we'd be over here. If it were equal to the unemployment rate, it would be along the long run aggregate supply curve, because that's where potential GDP lives. All right, so that's number two. Now, number three has to do with the consumer price index. It looks to me like we start at 0.6% and we end up at 0.8. So I'm going to say that the trend there is upward. And remember, we're just looking for trends. We're not, there could be ups or downs in the different periods, but generally speaking, we're going upward. So that would mean that we must be moving in this direction. Along the y-axis, price levels are increasing. So now our question becomes, to really understand where the economy is, we know that the equilibrium must be to the left of long run aggregate supply. We know that has to show an increasing price level and a decreasing level of real GDP. So the question is from here, how do we get that condition? How do we get that condition? Well, let's just play around this first one and see where we go. Okay, so if we shift aggregate demand to the right, if aggregate demand increases, this doesn't work, because our new equilibrium, where I'm pointing to, is showing real GDP above potential GDP, and and that's not the condition that we have. It is showing increasing prices, because we've gone from this point to this point, which means prices are going up. That's right, but we're on the wrong side. So that's not going to work for us. All right. So let's take that away. Let's see if going in the opposite direction works. Okay. We shift aggregate demand to the left, and now we get an equilibrium over here. We got a recessionary gap. Okay. We are on the right side of long run aggregate supply. But we have prices going down. The price level is decreasing, which means that this can't be the correct answer. So let's take that away. Well, it turns out we can play around with aggregate supply as well, but it turns out that what makes this work for us is if aggregate supply shifts to the left, if aggregate supply decreases, okay, that moves our equilibrium to point B from point A. And that does show us with higher prices and an economy that's below performing, because we're on the left side of the long run aggregate supply. So we know that these conditions from this data that we're given must mean that we had a cost push inflation cycle start. Inflation means prices are going up, and we are in a recessionary gap. Okay. So we're having a recession with rising prices. Okay. We're in a recession with rising prices. Now, based on the above, what could have caused this? Well, I'm not asking you, we already know what happened. Okay. We know that aggregate supply decreased. Okay. Aggregate supply decreased. So that's what happened. What I want you to describe is how it happened. The analogy that I draw in my classes is I run through a red light at an intersection and I hit another car, and the policeman shows up a couple minutes later and he says, "What happened?" And if I say to him, "Well, I hit this other car," he's going to go, "I can see that. That's the result of what happened, but I want to know what caused the accident. Did you go through the red light? Were you speeding? Did you take your eyes off the road for a minute? What happened?" So we want to do that economically with these problems here. So we are going to start with the idea that we know that aggregate supply decreased. Okay. And from our study of what causes aggregate supply to shift, short run aggregate supply, that is, there's only two things that could cause it to shift. Okay. One is a increase in money wage rates, or an increase in the money price of input costs. Okay, now money price is a code word for nominal. So if nominal wage rates went up, or the nominal price of other costs, other input costs went up, that's going to cause aggregate supply to decrease. And the logic there is, as we've learned before, is that if it costs more for manufacturers and producers to make something, their profit goes down at every given price, and therefore they're going to want to produce less of that good at every given price. That's why aggregate supply shifts left. Now, we can make up a reason why that happened to sort of play the game of the problem here. So let's just say some examples would be government doubled wages. The government did some type of wage legislation that doubled government wages, or government or doubled everyone's wages. So that would be a fiscal action, okay, monetary policy. Or we can say that maybe there was an oil shortage. So OPEC stopped producing oil, or contracted the supply of oil, which increases the price, which causes aggregate demand to shift. So anything like that. I'm just asking you to be a little bit creative, but really, really what I'm looking for is, do you understand what causes it to shift and which direction? Okay. And you should have gotten plenty of practice with that on your graphing exercise. On the graphing exercise, we went from the shock or the event that caused the shift to the shift, right? I asked you to take information like this and tell me how it looks here. Now I'm just asking you to take this and tell me what happened to get there. Okay. Now we got that far. We drew the model. So recommended fiscal policy. I'm just going to go over this quickly. Fiscal policy, we would want to be something that helps the economy get back to where we are going. Now, where we want to be, which is at equilibrium. Now, if the government did double wages, we could pass a fiscal policy that says undouble the wages, which would shift aggregate supply back to where it was. More likely, though, the control of the government and the control of the Federal Reserve on the economy typically work through aggregate demand. Aggregate demand is easier to manipulate from the federal perspective. In fact, it's almost all the Federal Reserve can do with its tools is increase or decrease aggregate demand. And fiscal policy in the short run typically focuses on aggregate demand. So I would be hesitant to play around with aggregate supply, short run aggregate supply in these examples. That's a little bit more rare. So fiscal, the way we're going to get out of this is if we get aggregate demand to increase. I didn't like that line. Increase and get us back to equilibrium at point C. So what would cause that to happen? Well, if the government has to stimulate aggregate demand, they could increase government expenditures. That's the G in Y equals C plus I plus G plus NX. Or they could do something like lower taxes, which increases discretionary income, which increases aggregate demand. Okay. Now, from a fiscal perspective, I'm sorry, this is a little bit all over the place. From a fiscal perspective, only three things can happen. We can adjust the interest rates. We can adjust the reserve rate. And we can do an open market operation. Now, if the Fed lowers reserve rates, lowers the interest rates, and does an open market purchase, those things will increase the money supply, which increases aggregate demand. Okay, that's it. That's all I would want to see for you to answer this problem. Okay, all right, let's try another one. And I'll try to go a little bit faster because I think you probably have an idea about what's going on now. So let's start again at the top. Before I do that, let's draw the model here so I don't have to do that again. Okay, we want to start at the same place whenever we're doing this. Always label your axes, but you're not going to have to draw on the exam. But just, when you do this stuff, you want to be right. Okay. There's aggregate demand. And here is our short run aggregate supply. Now, in the book, they say SAS. It's basically the same thing as AS in my models. All right, so let's look at the data. So GDP growth, in this case, we were going from 0.5 growth in one quarter to 1.1. So it looks to me like we have an increasing trend, which must mean that we are moving in this direction along the x-axis. With unemployment, we're going to do the same thing. We're starting at 6%. And remember that our natural unemployment rate is 4.5%. And you can use that number for the exam, 4.5%, if you want to remember that. I think I'd give it to you in most cases, but just in case, you can just assume that it's 4.5. We're starting at 6%, and then we're going to 4%, which is below the natural unemployment rate. So we are decreasing unemployment, which means that we must be on the right side of long run aggregate supply. It means that we're over here because remember, if unemployment rate is below the natural unemployment rate, that means that we are above full employment. We're using more labor than we would expect to be using with the economy at potential GDP. And that means that that real GDP must be greater than potential GDP. So that's what gets us on that right side. Lastly, let's look at inflation. The CPI in this case is going up like it was in the last scenario. So we have to be moving in this direction when it comes to prices. So you can play around with the lines moving. I'm just going to cut to the chase here. In this example, the only thing that would give us the scenario that we want is if aggregate supply increased. That would move us to equilibrium point B from equilibrium point A. So we know that we have an increase in aggregate demand and we have inflation, so we must have demand pull inflation. The last one was cost push. This one is demand pull because the inflation cycle started with demand. All right. Now, let's see. Well, when it comes to demand, I think it's pretty easy to come up with ideas because demand is a function of the aggregate demand curve is a function of what changes GDP. So from this list, from this formula, we can think of things that would cause any or all of these components to increase: consumption expenditure, income expenditure, or excuse me, investment expenditure, government expenditures, or exports. So let's just take an easy one. Let's say that Peru, which imports from US, that makes it our export, has a thriving, growing economy. Okay. And if that would cause exports to go up. And if exports go up, so does aggregate demand. Okay. So all of a sudden there's a big demand for US made something. And they buy a lot of it, which is enough, and it's enough to cause aggregate demand to increase. Okay. So we have, as a result, we have an inflationary gap. Okay, with inflation. So again, we're going to focus our policy efforts on aggregate demand here. So with monetary policy, very easy. Let me add a page here to make it a little bit clearer. Okay, with this one, monetary policy. Sorry, my writing is a little bit off today. Again, it's interest rates, reserve rate, or open market operations. And if we, in this case, we want to decrease aggregate demand, we want to shrink the economy slightly, and we want to get it back to equilibrium at point A. So we are going to raise interest rates, raise the reserve rate, and do an open market sale. All of these things will decrease the money supply, which will have the result of decreasing aggregate demand. Okay. And by the way, this is exactly why the Fed has a conflict when it has to fight inflation, because the way it fights inflation, as you can see, is by shrinking the economy slightly to get back to equilibrium. But that is going to cause a little bit of unemployment and a little bit of slowdown in the economy, maybe some businesses close. But from the Fed's perspective, it's better to take a little bit of short-term pain to get us from B back to A, because if we don't do that and we continue the inflation, it might turn into an inflation spiral, which is much worse for the economy. All right, fiscal policy. So for fiscal policy, we want to shrink the economy. So maybe that means decreasing government expenditures. Maybe that means, did it backwards. Increasing income tax. Okay. And all of these things have the effect of decreasing aggregate demand. All right, there you have it. Two scenarios, inflationary and recessionary gap. Okay. The only thing different about the third example would be that we might have aggregate demand shifting to the left, which would cause a recessionary gap, but with deflation. Okay, that would cause a recessionary gap with deflation, but the answers and the methodology still apply. Okay. If you have any questions about this, please let me know. I will try to post this so you have it for reference. I don't know if it's very clear, but at least you'll have this video to study from. So happy studying, and I will see you on the other side.